To me, it's a matter of when, not if they print the money. This is just what I think is going to happen. It's my prediction. Strait of Hormuz closed. Global liquidity is going to cause a crisis, and they're going to print money. And I would say, before all of this Iran stuff, I was like, it could be a month, could be 6 months, could be 9 months. I don't really know when credit is going to become such a problem. With this crisis, if the Strait doesn't open in 1 to 2 weeks, I don't know. Latest May.
In recent weeks, the global market has been reacting to headlines about war, oil supply disruptions, and rising geopolitical tension. But according to Jack Mallers, the real story isn't what most people are watching on the surface. Behind the scenes, the financial plumbing that holds the entire system together is starting to show signs of stress. And when that plumbing begins to crack, the consequences don't stay contained to one region or one market. They spread through credit, liquidity, and debt, the very foundation of the modern financial system. Mallers argues that what makes this moment different is not just the conflict itself, but the timing. Global debt levels are already at historic highs, bond markets are already fragile, and liquidity conditions were already tightening before any disruption in energy markets began. When you add an oil shock on top of an over-leveraged system, the pressure builds quickly. And in a world where governments, banks, and corporations all depend on constant access to cheap credit, even a small disruption can trigger a chain reaction that forces policymakers into decisions they don't want to make. That's why Mallers says the question is no longer whether the system comes under stress, but how long it takes before something breaks badly enough that central banks have no choice but to step in again. Because every time liquidity disappears, the same solution eventually comes back: intervention, stimulus, and money printing. And if that cycle begins again, the impact on Bitcoin, crypto, and global markets could be much bigger than most investors are prepared for. So in this clip, Mallers breaks down how an oil shock can ripple through the bond market, why liquidity is already flashing warning signs, and why he believes the next phase of this cycle could force the kind of response that historically sends hard assets higher. But before we get into it, if you enjoy this type of macro and crypto analysis, make sure to subscribe to the channel and turn on notifications, because this cycle is moving fast, and the signals that matter most are not always the ones making the headlines. Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit? You could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth? Tax-free. You keep the full $50,000. Same crypto. Completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time.
How does an oil shock break our financial system? Well, this visual is meant for you guys to screenshot and share with your friends. The Strait of Hormuz closes. It's estimated a fifth, a fourth, some high percentage of global oil is just shut off. The petrodollar system breaks. So all of a sudden, oil producers stop recycling the oil for dollars, and those dollars go to treasuries. Those treasuries are lending to the U.S. So a big source of demand for treasuries stops. Yields go up, which means the bond prices fall. The collateral in the financial system gets destroyed. People start selling their treasuries to finance. Like when countries like Thailand are running out of fuel, how do you think they get their country and their people gas? How do you think they get their country and their people food? They're going to sell their collateral. They're going to sell treasuries. They're going to sell stuff. And inevitably, it forces either an utter and complete collapse of the financial system, or it forces the Fed to print money. So Michael Howell, highly recommend subscribing to his stuff. I've learned a lot. He has something called the GLI, the Global Liquidity Index, and what he's trying to do is estimate global liquidity. And as I've talked about on the show, Bitcoin, for all intents and purposes, is a reflection of global liquidity. It's priced almost primarily and entirely on the expectation of future fiat. So as liquidity gets tight, Bitcoin tends to sell off, at least for now. Obviously as it gets big enough and becomes a viable gold competitor, that will change. But today, it's about the size of Tesla. It trades more like liquidity plus technology. It's like a hybrid of tech and liquidity. It's like macro technology. So understanding global liquidity and the trends are really important if you want to understand the general outlook and pulse for Bitcoin. Michael wrote a really terrifying piece, actually, where he said his global liquidity index projects a 28% decline. And he cites oil, the MOVE index, which we'll get into in a second, and the US dollar. But he says his global liquidity index is projecting levels that scream financial crisis. So levels that scream things like 2008, levels that scream things like COVID, levels that scream credit crisis. At this point, if the Strait of Hormuz is closed for another week or two, everything's going to blow up, financial markets wise. Excuse me. I can't mince words here on this show, given all the context. So anyways, what is the MOVE index? We've talked about it a lot on the show. Just to remind you guys, the MOVE index, it's measuring bond volatility. And so the reason the MOVE index is so sensitive is because right now, the marginal lender to the United States is actually levered hedge funds. And so what hedge funds do is called, carry trade, basis trade. And so they are doing a tiny, tiny, tiny little arbitrage, but, say they're making less than a penny on an arbitrage trade. You're like, well, what's the good in that? What am I supposed to do with less than a penny? I can't even get a piece of gum for that nowadays. Yeah, but what if I can lever it times a billion? Then, less than a penny times a billion every second all of a sudden turns into a lot of money. But the reason that you're able to do it at such a scale is because of leverage, because you're borrowing capital. Now, what is the enemy of leverage? Volatility, right? And so when the MOVE index gets higher and higher and higher, which measures more and more and more and more bond market volatility, that creates more instability for the bond market, because the higher the leverage, the higher the volatility, then the unwinding of the leverage that's ultimately supporting the bond market. But the MOVE index is now above 100. Before the conflict, it was below 50. So it has more than doubled, and it is well on its way back to crisis levels.
For many who think predictions of a system collapse might be exaggerated, Mallers points to three disturbing developments building in the background, while the market still appears relatively calm. The first is the sudden instability in Western bond markets, where yields have been rising at a pace that historically only shows up during periods of severe financial stress. When short-term government bond yields jump sharply, it signals that investors are demanding higher returns to hold what are supposed to be the safest assets in the system. That kind of move doesn't happen in isolation. It usually means liquidity is tightening, leverage is being forced out, and large players are starting to sell assets to raise cash. The second warning sign is the surge in volatility in the bond market itself, something tracked closely by the MOVE index. This index measures how unstable U.S. Treasury markets are, and historically, when it spikes to extreme levels, it coincides with moments when the financial system is close to breaking. The 2008 crisis, the COVID crash, and the regional banking stress in recent years all showed the same pattern. The third signal comes from credit spreads, which measure the difference between safe government debt and riskier corporate debt. When those spreads widen while stocks are still relatively stable, it often means the credit market is already pricing in trouble before equity investors realize what's happening. According to Mallers, when you combine rising yields, rising volatility, and widening credit spreads with an energy shock that forces countries to sell their reserves to pay for fuel and food, the result is a tightening of global liquidity that can quickly push the system toward a crisis. And historically, that is exactly when central banks step in and start printing again.
So very interestingly, Bitcoin has outperformed gold tremendously since the beginning of the conflict in the Middle East. Really interesting. I continue to believe Bitcoin's just too small to be the world's store of value at the sovereign level. I said earlier in the introduction, Bitcoin's market cap is $1.4 trillion. China's trade surplus on an annual basis is about that size. So it can't be yet the asset that these sovereigns pile into. It's just a little small. It'll get there. Right? It's just It's actually one of the cool things about Bitcoin is that it allows the little man an advantage, because the larger folks, like when I first got into Bitcoin, it was too small for anyone like Sailor and Strategy to be doing what they were doing, right? So over time, it scales and grows into different use cases. So it's still too small to be competing at a sovereign level with gold. But it is interesting that since the conflict started, it's been the de facto safe haven. And I think it's very telling because of the properties of the money. If I was in the Middle East or I was in some conflict area and I needed to get money and take it with me, or I needed to get money out, I would not have gold. How the would I travel with a bunch of gold? How would I keep a bunch of gold safe? Again, I can take Bitcoin, I could put it on a USB stick, I could put it in my backpack. Nobody knows I have it. That's the other thing. It's hard to hide that you own a shit ton of gold. You know, people come over to your house, people see your vault. I mean, you'd have to register with a bank if you wanted to store it with them. With Bitcoin, I could put it on a USB stick. Nobody knows how much money I have. Nobody knows that I even have it on me. I could put 12 words in my brain, memorize it. So I find it interesting when people say, "Oh, gold's the de facto safe haven." Gold is what China is using to rotate out of the U.S. dollar and bonds and the current, 1971 fiat system and into something else. That they're just used. But when there's real conflict and real danger, Bitcoin seems to be the better money because it has better properties. It's more divisible. It's easily transportable. It's easy to store. It's weightless. I don't have to lug it around in a truck. It's invisible. Nobody knows that I have it on me. It's better at being money at the end of the day. And the other thing that I will say is, guys, if you zoom out long enough, Bitcoin's been chopping around for like almost 2 years now. Just been around this, 70 to 100 to 60 to 80. When they print the money and this thing moves, this thing is going to rip. It's been built Bitcoin's been impressing me through all of the U.S. President comes out and says something. The world's calling him a big fat liar. There's more conflict. There's more war threats. Israel doesn't seem to give a what anyone's saying. They're just bombing the shit out of Iran no matter what. Bitcoin's hanging in there at 70. It's hanging in there. Since the conflict started, it's greatly outperformed the stock market. It's greatly outperformed gold. Really impressive. Really impressive. And as someone that works on the protocol, builds companies, I don't care for the near-term price action. I don't give a if, in fact, the near term with Bitcoin going down, it's a great opportunity for me to buy dips, for my companies to buy dips. So I pay it little to no mind. It's the long term. Does Bitcoin have the properties that make it the best money? If not, I'm going to work on something else. And this is super inspiring because it just does. If I have to get capital out, if I have to hide the fact that I have capital, if I need privacy, if I need mobility, Bitcoin, there's just nothing better. There really is nothing better.
And this is where Maller's argument starts to connect directly to Bitcoin. Because if the pattern he's describing plays out the way it has in previous cycles, the next phase is not simply a market correction, it's a liquidity event. When credit tightens, leverage unwinds, and governments struggle to finance themselves at higher rates, the pressure builds until policymakers are forced to respond. Not because they want to, but because the alternative is a full-scale financial contraction that the modern system simply isn't built to withstand. What makes this moment especially interesting is that, despite the conflict, the volatility, and the stress in bond markets, Bitcoin has not collapsed the way many expected it to. In fact, it has held its ground and in some cases even outperformed traditional safe haven assets. Mallers points out that this may be a sign that the market is starting to understand something important, that in a world where capital controls, banking risk, and currency debasement become real concerns, portability, scarcity, and self-custody start to matter more than ever. He also makes the case that Bitcoin is still early in its role as a global asset. At the sovereign level, gold still dominates because of its size and long history, but Bitcoin's advantage shows up during moments of real uncertainty. When people need to move money quickly, store wealth privately, or protect themselves from instability in the banking system, the properties of digital borderless money become much more obvious. And if liquidity conditions force central banks back into stimulus, the assets that benefit most are usually the ones that can't be printed. That's why Mallers believes the real signal right now is not whether markets are nervous, but how they react if liquidity actually breaks. If the bond market continues to show stress, if credit spreads keep widening, and if energy shocks continue to drain reserves around the world, the probability of intervention goes higher. And every time the system has reached that point in the past, the result has been the same: more money creation, weaker fiat currencies, and stronger performance from scarce assets. For Bitcoin and crypto investors, that doesn't mean the path will be smooth. Liquidity crises often cause sharp drops before the printing starts. But historically, the biggest moves have come after the moment when the system looks the most unstable, not before it. And that's why Mallers says the real question isn't whether volatility is coming, it's whether investors understand what usually comes after it. If you found this breakdown useful, make sure to like the video, subscribe to the channel, and share your thoughts in the comments. Are we heading into another liquidity cycle, or is this time different? Most importantly, what does it mean for Bitcoin and the overall crypto market? Let me know your thoughts in the comments, and thanks for watching.